Retail and tech earnings dominated the headlines on Wall Street this week. We heard from major players including Salesforce, Hewlett-Packard, Chewy, Lululemon, Best Buy, and more. Here's a look at some of the top moments from our coverage. Best Buy beat on earnings for the second quarter, but joined other retailers with a less than stellar outlook for the year ahead. The company saw sales fall significantly across higher cost categories like appliances and computers, and shoppers under pressure cut back. Best Buy also warning that tech demand would hit a low in 2023. Home Depot and Lowe's saw a similar slowdown in big ticket categories during the second quarter. Target also hit hard by a pullback in discretionary spending. But the value-centric Walmart saw its sales increase in the second quarter on the back of its robust grocery division. So what can we make of the latest retail earnings? Joining us now, we've got Michael Baker, D.A. Davidson, Managing Director and Senior Research Analyst here. Michael, perhaps we put that question to you first. If you are to sum up the retail earnings that we've seen thus far, broad stroke, what would you kind of summarize it as?
Well, the consumer is definitely slowing. We're seeing that across a number of retailers. You just highlighted several. The consumer is spending more on needs rather than wants. And overall, we are seeing, again, a little bit of a slowdown. I will say relative to expectations for some of these names reporting, for instance, Best Buy today, it's not worse than expected. So as it relates to the stock price, that's why we're seeing the stock up a little bit today. But broadly speaking, the consumer is slowing. I don't think that's such a bad thing. It feels a little bit like a soft landing to me. We are seeing a slowdown in spending. Still, the consumer is out there spending because the consumer has a job, but it's more on, again, needs rather than wants, and a little bit less spending than we saw earlier in the year.
And so talk about some of the key themes that have really dominated this retail season. Obviously, when you look at Best Buy, they don't have as broad of an offering as, say, as an Amazon per se. But which are the themes you think really stood out to you?
Well, from a top line perspective, again, it is a slowing consumer. On the margin side, we didn't really hear it much from Best Buy today, but certainly shrink has been a big issue. In fact, Best Buy shrink is actually really well controlled, so that's a positive for them. But overall, we've seen some margin pressure from shrink. On the other hand, supply chain costs are getting better. One thing we're hearing more and more of, and it seems amazing to say it, but is disinflation or even deflation in some cases. Of course, for much of the year, the conversation has been inflation. Now we're seeing a little bit of disinflation and how that actually weighs against sales in some respects, in that you're just getting a little bit less price realization. Now, theoretically, and we think as we get close to the holidays, if we are seeing a little bit of disinflation in some of the core consumable food needs-based categories, that might mean a little bit less crowding out of the wants, and we think it could help holiday sales for some discretionary items. For much of the year, it's been consumer having to wrestle with the inflation in food and then buying less of the wants. That could start to alleviate itself as we look towards the back half of the year.
Yeah, I've seen some of those Best Buy associates shift into a 3-4 NFL defensive formation to control shrink, and they've done pretty good at it. To your point there, Michael, as we think about Best Buy and what was reported this morning, it's particularly interesting as well in some of the categories where consumers are continuing to show that they're either looking for a big discount or waiting for a major sale or promotion to take place. What can you extrapolate from these numbers and apply towards, say, the Labor Day sales, or even further out, some of the holiday shopping season sales? Are we going to see major doorbusters and those deals that consumers have come to expect on a cyclical basis because there's inventory that needs to be moved through, or just because Best Buy is going to have to do something to entice the customers back into the store here for some of the larger ticket items?
Sure. A lot there. So it is a more promotional environment. Absolutely. We are seeing it more promotional. We expect that over the holiday season. It's more because of the second thing you said. It's just to, spur demand and get people to come on in and shop. It's less about inventory. Inventory is actually pretty clean right now, not just for Best Buy, but for a lot of retailers. That was a major issue last year. Most retailers, not all, there's still some pockets of heavy inventory, but most retailers have their inventory well under control. But it is more promotional just to get the consumer to come back in. As it relates to Best Buy, the good news is a lot of it is vendor funded right now, because the vendors have the same incentive that Best Buy has, and that's to get people back in the store. So it is more promotional than last year. it's going to look, this holiday season is going to look a little bit more like it did pre-pandemic, which is those traditional doorbusters and those types of things, those types of calls to action. Best Buy did say something interesting on the call today, and that is that some of their back to school categories are actually doing better than expected. Typically, that bodes well for the holiday season. Back to school leads and points the right direction for holiday sales in 85% of the time.
And so does that mean that we are to believe in, and is expected now that the worst in the tech demand and that lull is behind us?
It does feel like that. So we're still down year over year. But remember, we were down 10% in the first quarter and towards the end of last year. This quarter down 6%, and they said in Best Buy is trending at down 5% in August. Still not out of the woods yet, but getting a little bit better. And Best Buy does think it's possible that holiday sales could be closer to flat. So we are trending in the right direction. There were some interesting green shoots that we heard about in talking to the company. Laptop units were actually flat year over year. That's a good sign. TV units are actually up year over year. Gaming was a strong category. So there are definitely some positive signs that we're seeing.
And Michael, as we're seeing consumers continue to trade down or trade off, which of the retailers do you think are best positioned going into the holiday season and beyond, keeping in mind that we are in an interest rate higher for longer environment?
Yeah, well, bigger picture, we think among the best positioned retailers this holiday season is Walmart for sure. They span the spectrum of categories, but when the consumer is trading down, we are seeing some of that. We think we think Walmart is particularly well positioned in this environment. We think the clubs as well are well positioned. A name like BJ's has added a lot to their general merchandise offering, and we think that could help their holiday seasons. Costco always does well in that kind of trade down environment as well.
And so from an investor perspective here, I mean, when you think about some of the top names in retail that investors should be paying closest attention to, even amid what Corey Berry, the Best Buy CEO, continues to call a very kind of unfamiliar or all too familiar macroeconomic environment with several challenges, who would some of those top picks be?
Well, it's all about expectations and what's already embedded in the stock price. And sometimes the best sales performance doesn't necessarily mean the best stock. But that being said, best ideas, again, Walmart, we think is particularly well positioned here. We like Ulta on the pullback that we've seen. We think that represents good value for a name taking market share. Another name that we highlighted as a best idea earlier in the year and has done particularly well, we haven't really talked about in this conversation, O'Reilly Auto Parts. That space is doing very well. And then the last one we'll throw out is Lowe's. Lowe's has been a particularly good stock this year. For them, it's all about closing the margin gap with Home Depot. And through new management over the last couple of years, they've been able to do that.
It certainly makes sense as people try and, do more at home with their cars and with their homes as well. That those are some of the companies that will also be doing well. A big thank you there to Michael Baker, D.A. Davidson, Managing Director and Senior Research Analyst. Thank you for your time this morning.
Hewlett-Packard Enterprise out with better than expected results, in large part because of demand for all things AI. Let's get right to the man of the hour here, HPE CEO Antonio Neri. Antonio, always great to get some time with you here. So let's start on the macroeconomy and the impact to your business. Is the economy in the U.S. and around the world starting to cooperate with a company like yours?
Well, I think we continue to navigate some uncertainty in the macroeconomic environment, but I will say IT continue to be a top priority for customers because they need IT to operate in this digital world. And what we saw in the Q3 earnings is that we saw sequential order improvements. The demand improved across all our key business segments, but obviously the star of the demand, I will say, the leader was AI, where we saw a wave of acceleration, also coupled with our HP GreenLake cloud platform. So we have a unique portfolio, and we're taking advantage of the diversified portfolio we have.
Lots to unpack in that AI part of your business. I will touch on that, I promise. But on the enterprise spending, when you talk to large customers, are they still making tough choices? Are they loosening up their budgets? Has that changed at all compared to 3 months ago?
No, I think it continues to be the same, right? So we see areas of the portfolio where the sales cycles continue to be elongated. So they're taking the time, perhaps more approvals in the process. And we see areas where are really becoming stronger. So, for example, everything related to connectivity, connected people, devices, and things to accelerate that data-first modernization, digital transformation is core, because they need to be more effective and efficient in how they conduct the business. And obviously, we saw a significant uptick in AI because everybody wants to adopt AI into the business model. So depending on the area of the portfolio, in some areas, elongated cycles, some other areas, a little bit of more frothy, if you will, but ultimately, all in the right direction, because IT will continue to grow on a long period of time.
For the investors on our platform, Antonio, that may not be totally familiar with your business. You saw a large uptick in sales in the intelligent edge business, up 50%. Does that reflect demand for AI-related services and products?
Well, remember our portfolio. So we have a cloud platform, which call it HP GreenLake. Is a true hybrid cloud platform where we give customers the ability to deploy hybrid IT across the entire estate, whether it's to put workloads and data in the public cloud or on the premises in a co-location or at the edge, even more now. And so that's our HP GreenLake platform. That platform now has, under the umbrella, $12 billion in cumulative total contract value, and 5 years ago was zero. And then ultimately, we continue to drive that business through the software and services mix, which improves sequentially, again, 2 percentage points, which drive obviously higher margins. But that business grew 122% year over year. And underneath that, Brian, we have 3 core businesses. One is the edge, which is obviously the connectivity business, the networking business. That performed exceptionally well. Is the 5th consecutive quarter of record-breaking revenue and profit. Now that intelligent edge business represents 20% of the total company revenue and almost half of the company profit. 2 years ago, it was less than 10% and less than 15%. So massive improvement there. Is the new core, I would call it, of the company. Hybrid cloud obviously includes compute and storage, which tends to be more cyclical. But at the same time, we have a lot of infrastructure as a service and SaaS, and then obviously AI. And so when I think about our results, clearly we have transformed the portfolio. We continue to make shift to higher growth, higher gross margin areas. And now we see AI as a turbocharge in the future. And we embed AI in everything we do. But if I think about AI, think about how people train data, tune models to their data in a private, secure, responsible way. And then obviously how we use that in our production models, what we refer as AI inference models.
Within your backlog figure, is there a number to parse out in terms of total AI demand? Do you have an idea on how much demand you are building in your book of business because of the AI solutions that you have?
Well, it has grown triple digits, no question. And we exit Q3 with the largest ever order book in our HPC and AI segment. And that was symbiotic with the HP GreenLake, because HP GreenLake offer all of that as a service. So it's an accelerator of HP GreenLake, but also AI needs HP GreenLake to offer in a pay-as-you-go model. And then in the rest of the business, we embed AI in our SaaS offerings. Everything related to networking, compute, and storage has now more and more SaaS attached, because that software delivers the experience that the customers need through the infrastructure. And that has a component of AI now embedded and will continue to grow as we go forward.
You mentioned on the earnings call, Antonio, NVIDIA. Do you work with them? Do you get chips from them?
Absolutely.
Can you get the chips you need from a company like that? Because all we hear from the outside looking in is that prices for these H100 chips have gone through the moon, and there are essentially only a couple companies getting the chips they need.
Not really. I mean, we work extremely well with Jensen and his team. It's a fabulous team. We have an amazing relationship. In fact, I just spent more than a half a day with him and the team just 10 days ago in his headquarters in the Silicon Valley. We talk about how we grow together, how we bring both sets of assets in a way that democratizes AI for everyone. So I'm very bullish about that. And we have unique value that we bring to the table. Because let's be clear, HPE has been in the AI space for a decade. We have done AI for unique customers in academia, government, and very, very large enterprises that built specific built-for-purpose systems like supercomputers. Remember, we have deployed the largest supercomputers on the planet, and we have more to come as we look into 2024. And so it's a very symbiotic relationship. Now, our demand had outpaced any supply availability, including for NVIDIA. But what we booked in Q3, only a very small fraction actually shipped. And remember, the revenue recognition that business has additional conditions, which is not the type of shipment, but also the time of receiving and acceptance of these massive systems we deploy.
As someone that has been involved in tech for some time, Antonio, does this feel like a special time in the industry to you? And
Yeah.
what do you think's on tap? What's the biggest thing next year you think we'll all be talking about?
Well, I think about the AI as one of the most important, if not the most important inflection point, at least in my lifetime. I compare this to what I call the Web 1.0 or the mobile shift that we saw. And obviously, it has the potential to disrupt every industry, but also address some of the biggest societal challenges we all live. So it's not just for the context of business, but also in the context of the challenges we live. Think about it, how we accelerate, the reduction of their carbon footprint. When you think about using AI and supercomputer technologies to innovate new technologies to reduce the carbon footprint, we see that every day in climate research and also in things like modeling simulation. When I think about finding cures for diseases like dementia, Alzheimer, and think about COVID, the reason why we got to a vaccine in 9 months is because we had accelerated computing that allowed us to accelerate the research for these compounds that ultimately address these viruses. But there's so many use cases out there. The key here is to do it in a sustainable, responsible way. And sustainability is going to be essential because this type of accelerated compute consume a lot of power. And Hewlett-Packard Enterprise is uniquely positioned to deploy the most sustainable supercomputers on the planet because we have that expertise. So we believe we're on the cusp of some revolution. What comes next, I don't know exactly, but I will say, obviously, we see quantum computing emerging along the way, neural computing as well. So it's just a remarkable time to be in this industry. And I have a lot of fun with my team tackling the challenges and the opportunities.
And we've had a lot of fun following all these things that you guys continue to work on over there at HP. Antonio Neri, always great to get some time with you. We'll talk to you soon. We appreciate it.
Thank you, Brian.
JM Smucker reporting some mixed results for its first quarter before the bell. A miss on net sales, but profit beating expectations. The company also boosted its profit guidance for the full year as higher prices on its peanut butter and jelly offset rising costs. Joining us now on these results and more is Mark Smucker, JM Smucker Company CEO. Appreciate you joining us this morning here. So break down the results for us here. Obviously, we saw some strength in that peanut butter market. How surprising was that?
Actually, Rochelle, we had great results, and we did actually meet expectations on the top and bottom line and actually raise our guidance both for gross profit and our EPS. So results were strong across every one of our categories. That would be coffee and our pet foods, pet snacks, as well as our spreads and Uncrustables business. We had fantastic results, both growing sales as well as our volume. So great quarter for us.
Mark, I'm glad you said that Uncrustables business. It's my favorite part of the business. It's easy. You just throw it in your bag, you pick one out later, and then you're good to consume. But at the end of the day, when you think about how this continues to kind of be a core staple in the broader lineup of Smucker's products out there, what is the next Uncrustables moment? What is that next product innovation that the team is zeroing in on to try and drive another type of product that has the same type of fanfare than Uncrustables has had?
Yeah, Uncrustables is on fire. We're going to hit $800 million in sales this year. We're building our third plant, and we're still in growth mode, even on core peanut butter and jelly. Obviously, we offer peanut butter and honey, peanut butter only. We have a chocolate hazelnut execution. And in the future, we will launch more products in that same format. We're thinking about meat and cheese, egg and cheese. That would be a couple years down the road, but it will be supported by this third plant we're building in Alabama. So lots of growth to come.
And Mark, we have to talk coffee here because, that portfolio continuing to do well. A lot of consumers, they're discerning, they're trying to see, maybe I should make more coffee at home, look at some other options here. How is that market playing out, especially when you look at the cost of food inflation?
Yeah, great question. Actually, our roast and ground business has been strong this quarter. We have seen a little bit of cost relief, which we've passed along to consumers by sharpening prices. But we just launched cold brew under the Dunkin' brand, and consumers are customizing, making their own often cold coffee drinks at home these days. And so that concentrated, already brewed coffee plays into them making those coffee cocktails in the morning at home.
Mark, you can have jelly or jam at any time of the day, but what you just said is particularly striking here in that it might give our viewers a sense that you want to play more in breakfast when you're talking about an egg and cheese potential. Is that something that you're looking to do more of, playing more in breakfast and at the start of the day?
Yeah, it's all about occasions, right? And so breakfast is clearly an occasion that our products definitely cater to, whether that's coffee or Uncrustables. And as you point out, potentially in the future, some other iterations on Uncrustables. But yes, breakfast is one of our key occasions. Peanut butter and jelly sandwiches are the #1 sandwich consumed at lunch. So breakfast and lunch are big for us.
I mean, certainly getting ready for back to school, packing these school lunches, you want that quick go-to, that PB&J. Talk about the back to school influx that you're seeing, especially as parents prepare. I mean, some parents are still going to be loyal to their brands. You know, kids are very picky, especially. How much does that help when you're looking at the back to school market?
Well, back to school is a key period for us, right? And our brands perform very well during this time period. And of course, PB&J, as we just discussed, is key in that. Our business has continued to grow in schools. You know, we're selling Uncrustables in schools. We're selling Uncrustables as well at universities, golf courses, and now convenience stores. So again, that product is really just a really great success story for us.
Mark, the reality right now, too, on the climate front, and something that perhaps you consider as well, is that this is one of the hottest years on record. It's changed farming. It's changed getting the commodities for companies like yourselves and the natural resources to allow you to be able to create a lot of these products, too. You know, how has this shifted the operations over at Smucker and where you kind of envision the future under a climate change challenged world?
You know, our operations are performing well, but we have to continue to be focused on doing the right thing for this planet. And, you know, we recently launched new climate goals. We've been very successful in, you know, reducing emissions, obviously offsetting water, you know, almost zero waste to landfill, and renewable energy. So we really want to do our part. It's really important as a company, you know, that we continue to minimize our footprint, and we will continue to focus there.
And has it changed the way that you source any of the ingredients?
A little bit with coffee. You know, coffee comes from 40 plus countries. We have invested in initiatives to help find different coffee trees that can perform better at hotter or lower altitudes, and without actually introducing new genetics into that. And so there's a nonprofit called World Coffee Research that we helped to fund and continue to support. So that's just one example of ways that we can support more globally some of those climate initiatives.
And Mark, obviously, it's a tough time for a lot of shoppers right now, not to mention you've got student loan repayments set to restart. A lot of shoppers are looking to trade off or trade down. How do you keep a competitive edge when, you know, if you're looking at, say, prices inside a Walmart for a different brand or off-brand, or pet food are cheaper? How do you manage the competition there?
Well, I think the most important thing to do for us is to make sure that we're playing in all segments of our category. So if you think about coffee and even Milk-Bone dog biscuits, we have offerings that reach the value consumer all the way to the premium consumer. So we're offering products, whether it's Folgers or Dunkin' as a more premium offering. Consumers have choice, and we're able to meet consumers where they need to be met and make sure that we're offering products that fit their budget and fit their lifestyle.
We do appreciate you taking the time to join us this morning. Mark Smucker, J.M. Smucker Company CEO, thank you so much.
Thank you.
Salesforce earnings were released last night, and the company not only beat expectations for revenue and adjusted earnings per share, but boosted its current quarter and full year forecasts for revenue, earnings, and margins as well. Like every other tech company right now, Salesforce mentioned artificial intelligence a lot on its earnings call. Co-CEO Mark Benioff explaining his aspirations for the company in the AI space. And to talk more about Salesforce as an AI play, we have one of the best guessers in the business, Brent Thill, a senior analyst over at Jefferies. Brent, make some sense of this quarter for us and your outlook as you continue to kind of parse through the numbers here and even the tenor of the call last night.
Yeah, good morning. The stock is going higher on margin, not really revenue. So Salesforce.com, came into the year massively overweight. They need to hit the Peloton and hit the air brakes on carbs, and they have done that, and that has seen a material outperformance in margin. The margins are continuing to improve. Revenue growth is still stuck in the low teens, and as Mark Benioff, the CEO, said, "I'm a growth CEO." They want that number higher, and we think ultimately, if you listen to all the AI hype. Today, it's not revenue. So the AI revenue wave is going to hit them. So effectively, the first wave of the stock outperformance has been on margin. The second wave should come with revenue outperformance. And, again, it's early in AI. I think they're a little behind. You're going to see the revenue from that have a bigger impact in 2024. And then I think, they've gone on a diet on M&A. They haven't done really any M&A. So the other thing that could help reaccelerate revenue growth is, do they lean back in and do some tactical acquisitions that help fill out the portfolio? So remember, the activists said, no more M&A. You got to cut your weight, get your margin higher. I don't care about revenue growth. And they set a goal of double-digit top line with high 20% operating margins. They're now there. And then the next leg of this is that margins are going to go, in our opinion, to 35 to 40%. And hopefully they can, reaccelerate revenue growth from low teens to mid teens. So story's still got a lot of legs. We think stock's going higher.
So Brent, a lot to break down in what you just said, but sticking with your last point there on M&A, because like you said, activist investors obviously were pressuring Benioff, wanted him to cut back on some of his spending. So here we are with Salesforce almost a year later, and like you're saying, in a much better position than it was 9 months ago. So what do you think, how do you think Benioff is thinking about potential M&A strategy, and what could be attractive to him?
Well, remember, they've been addicted to M&A. They've done so much M&A. They've done more M&A than most of the companies we cover. So they were hooked on a drug called M&A, and they had to go to rehab. So I think there's a lot that they could do. I think right now the number one area, obviously, is AI. Is there a tactical tuck-in or startup that has great technology, doesn't have distribution, that they could infuse inside their platform? That would be number one. Obviously, number two, they've been very open about acquiring inside their own portfolios. So marketing, sales, service, you go through all these applications. There's a lot of point solutions in the front office that they could tuck in on that side. But if you the number one thing for me would be a tactical AI tuck-in. Is there some enabling front office technology AI story that is out there? It could be 3 girls and 5 guys and a dog, right? That as a startup that they could do as a tactical. But I don't think they can go out and do a Slack-like deal. Remember, that deal went completely sideways, and they overpaid. So I don't think you're going to see anything like that. More on the smaller to mid-size than large.
As long as that small startup got that dog in them, it should be okay, and an acquisition target as well. When we think about AI, though, is the analyst community comfortable, or how do you even evaluate making sure that for the AI solutions that get introduced, that it's not cannibalizing other parts of the business?
Well, ultimately, it will over time. So if you think about what Salesforce.com does, is they sell service seats into a call center that you call. So a major airline, if you call your insurance company, they're most likely going to use Salesforce.com. And so AI at some point, like, we don't want to talk to these reps, nothing against talking to humans, but like we can get this answered by the computer. And so ultimately over time, what happens is if AI really works, it does reduce the number of seats available to them over time. Now that's a long ways out, but the flip side of this, they will charge more per seat. So if they charge $10 a seat, they can charge 20 because they're physically removing a human who's a lot more expensive than that piece of software. So I think for them, over time we'll see, and this is a long-term concern, not a short-term concern. The long-term concern is, is this going to reduce the number of seats available? Do you need as many sales reps or service reps? And again, I don't think that's a 2024 event. I think it's a 25 and beyond, but they will charge more per user. So their monetization will be at or greater than that for this. And then remember, a lot of people will add on, AI isn't going to fly the plane. It's basically it's going to be a co-pilot. It's not going to be the full pilot, as they call it. And so it's going to be augmenting rather than replacement. I was up at Microsoft this week looking at their AI technology. And again, it's not going to replace a human. It's going to effectively augment and make you more productive in what you do every day, get you through your emails, help you make presentations, help you prepare for that sales call. Even if you're a service agent, they may keep these bodies in place, but if you're working for a major airline, I know you're a VIP and I know that you're vegetarian and I know you like a certain drink. I'm going to do it right away based on the AI technology. And that makes you happier as a customer. You're going to come back and rebook. So again, it doesn't really mean right away we're going to have humans out of the picture. It just means it's hopefully going to be a better experience for everyone.
All right, Brent, we could talk about this all day, but we also got to get to another topic that I know you've been following here over the last several months. Elon Musk, he's adding another new feature to his soon-to-be everything app, X, formerly known as Twitter. Now he's planning to launch video and audio calls to the platform. Musk, he's desperate, right, to fend off competition from Meta Platforms' owned Thread. So how worried should Zuckerberg and Meta be just about these moves, or do you think Elon Musk is just grasping at straws at this point?
I think if you're Zuck, you're really not concerned at all about what is happening here. Again, I think the market's big enough. I think users go to the platforms for different reasons. I think for Meta, they've demonstrated through their expansion of their portfolio that they have a very sticky platform, that they can create all these features. I think, again, many use Meta and the portal with our hardware launch, many years ago to do video calls. I have a portal in my parents' house, so my kids can interact with them. So, that like video's been there forever. I mean, they have actually a device that people actually really like in living rooms that they're already using. So again, I think, the thing with Twitter and X is they've tried many times. And every time they kind of come back to users and they come back to advertisers, it's kind of like a broken record, right? They want a cleaner approach. They want something that works. And it's been a series of roundabouts. They just get stuck in this roundabout and keep going around. They need to figure out how do they break out of the pattern, if you will, and go somewhere new and do something exciting. So we'll see. We're not ruling them out. They have a lot of work to do, but I'm not worried if I'm Zuck.
Is Meta a net beneficiary then of some of the strategic question marks that still circle around X?
100%. 100%. I mean, advertisers right now are like, I'm not giving them as many dollars. I'm giving them back to Meta. In all of our checks, Google and Meta are taking market share away from them. They're taking share from others. So if you look at the outperformance of Meta stock up 145% plus year to date and Google up 54, that's because the users are staying there and they're getting advertiser market share. I mean, I just dropped, I don't know how much more money on the NFL ticket for YouTube TV, right? Just gave Google more money. Advertisers are excited about that. They keep innovating. And I think this is the thing, being big isn't bad. And they're just doing the right things for the users. And I just see, again, even in the AI race, Google's doing more AI things behind the scenes than anyone can see. They're way ahead of anyone else. And so the industry's saying that, Wall Street's not saying that, but that's why stock keeps going higher. Because, now they're winning, companies like Workday, Amazon's AI wasn't working. They had to go to Google. So Google and Meta are in really phenomenal positions. They're continuing to get stronger. They're doing the right thing for the consumers. And if they do the right thing for the consumer, guess who comes? The guys that pay the bills, those are the advertisers. They're not going to the other platforms as well. So Snap and Twitter or X have lost share.
Brent Thill, always great to have you. Look forward to having you back soon. Brent Thill, Jefferies senior analyst.
Lululemon reporting a beat on revenue but missing on earnings. However, the company boosted its net revenue forecast for the year. Shares are trading flat in after-hours trading. Here to dig into the numbers is Brian Nagel, Oppenheimer Managing Director and Senior Analyst. Brian, what do you make of this report, especially in comparison to other retailers like Dick's, for example, which certainly struggled in the quarter?
Well, good afternoon. Look, I think this is a very solid report from Lululemon. We're just digging through these results right now, but if I'm looking at the numbers correctly, I think you actually had a modest beat on the top line and a modest beat on EPS as well. It looks like the EPS came in at 268, which is maybe a 10, 15 cents better than the street number. So, look, I think the results here from Lulu are very solid. Okay, now to tie that over with Dick's, look, there was some noise in the Dick's announcement. Particularly around shrink, and that's been an issue. A lot of these retailers now have been focused, but behind that, behind the shrink issue with Dick's, their results were quite solid as well. So what I think we're seeing here is, really overall within this sporting goods and this athletic space, very solid results, continued indications of solid consumer demand.
Yeah, what does that tell you, Brian, about where consumers are prioritizing things? We were talking earlier before the break about how much we've heard from these big name retailers about discretionary spending coming down. You're seeing strength, you're saying with Dick's, with Lululemon. What does that tell you about sort of the mind of the consumer right now?
Sure. Look, I've studied the consumer for a long time, a couple of decades at least now. And I would say this is one of the most fluid, frankly, one of the most confusing consumer environments I've ever seen. And there's a lot of trade-offs, and it's definitely not one size fits all, okay? So to answer your question, look, I think what we're seeing here is a discerning consumer. Post-pandemic, there's clearly this shift back in spending to services, that's travel, eating out, sporting events, whatever. And so to a certain extent now that shift is impacting sales in categories that performed very well during the pandemic. But if you look at Lululemon, I think one of the big trends here is, so Lulu performed well through the pandemic, right? But I think what's happening here post-pandemic is, as a society, we are still dressing a lot more casually. So this ongoing strength in Lululemon, the double-digit sales growth, to a certain extent, is coming at the expense of more traditional clothing companies. Just because now we're dressing athleisure-wise, in more aspects of our lives, including work.
And you mentioned shrink and how that was a big problem for Dick's. There was no mention of shrink or retail theft in this press release. We'll see if it comes up on the call. But if shrink isn't a big problem for Lulu, why is that the case? Is it because it's in a higher end category?
It's possible. Look, it's an interesting question. Well, again, like you said, we're gonna have to see what they say on their call, because I'm sure it's gonna come up. But one piece, one factor is, a large portion of Lululemon sales are online. Okay, so that just by its nature protects from in-store shrink. But you also have a number of their stores are mall-based. Okay, so maybe there's better protections for these stores there. They're generally smaller stores. They've got a lot of service personnel in these stores. So all those factors can help protect the kind of shrink that we're seeing elsewhere, particularly more the big box stores.
I want to pick up on that point. You said a lot of their stores are mall-based. And when I think of Lululemon, I think of the mall. I think of these shopping centers. They are making advancements on the digital side, but we have seen a slowdown in foot traffic when it comes to brick and mortar. What's the outlook there? Do you think they're going to have to close more stores, or is that something they should be leaning in on?
Well, look, one of the big advantages of the Lulu model is, I've made this point for a long time now, is that they're really starting from scratch, right? I mean, this is truly a direct-to-consumer brand that uses the company's stores as a means to drive direct-to-consumer sales, okay? And that's very different than a lot of other brands and a lot of other retailers. You take Nike, for example. We're big fans of Nike too, but one of the challenges for Nike over the last few or several years now has been that they've had to sort of say dismantle or at least reconfigure their wholesale distribution network, as they had to think about their partnerships in wholesale. Lululemon has not had to deal with that. Their wholesale business is very small. It's direct to consumer. A lot of it's online, and a lot of it's in their own store. So when they open a store, and they talk about this a lot. I mean, that store, acts as a place to sell product, but also very much complements the online offering, right? And that's how they continue to open stores in the United States as well as in markets across the world. So I don't see them closing stores. I think they're very much in an optimal position here as far as store openings because they're picking off the best locations and doing it smartly.
I can tell you're very bullish on Lulu. You have an outperform rating on the stock. What are your biggest concerns, though, as we think about the future, the uncertainties with the macro environment, potentially more interest rates? We are seeing a more pressured consumer. Is there an area of the business that you are a little bit concerned about?
Well, we can't ignore the macro environment. Right, we can't. I mean, look, I'm of the view, and given my, kind of my perspective on the consumer, I think the consumer is holding in very well, despite rather significant interest rate hikes and other pressures out there. But I think the consumer is holding in very well. Now, but one risk is we cannot ignore this. I mean, if the U.S. economy, I don't think it's going to happen, but if the U.S. economy were to shift into some type of more significant recession. Here's Lululemon, and this is a high quality product. There's a lot of demand. There's a lot of passion around this brand, but it's high priced. And you got to think that if we went into a really significant consumer pullback, sales of Lululemon would get hurt. Okay, so that's one risk. The other fact, you got to keep competition. I mean, I think Lululemon's doing a great job within the athleisure space. I mentioned a moment ago they're taking market share from other kind of clothing brands. But look, it's a very competitive space. And the consumer has been historically fickle when it comes to this type of product. So we've got to see continued innovation from Lululemon. They've got to stay true to their brand to fend off this competition, either in terms of the major players like a Nike or a lot of the smaller players that keep on popping up.
Well, you're right about the higher prices. Those Lululemon yoga pants, they're not cheap. And I know that from experience. But Brian Nagel from Oppenheimer, thank you so much. Talk soon.
Thanks for having me. I appreciate it.
Dollar General shares are plunging this morning after slashing sales forecasts and taking a hit from a decline in store traffic. The discount retailer became the latest to warn about inventory shrink as well, joining other companies like Five Below and Dollar Tree, who also voiced concerns. Joe Feldman, who is the Telsey Advisory Group analyst, joins us now. Joe, good to have you here with us this morning. As you think about what we've heard over the course of this retail earnings season and ultimately what Dollar General has come out and communicated, should there be any surprise here from your perspective?
I think the surprise here for me is really on the top line. That we knew about inventory shrink running higher for retail, broadly speaking. We knew that that's been a pressure on the gross margin. We've known that markdowns have been ticking a little bit higher. So we've seen that profit pressure from a lot of others. But a lot of its discount peers and dollar store peers like a Dollar Tree, a Five Below, Walmart, and Ollie's and others have all done pretty good on the top line. Their sales forecasts also held in fairly decent for the back half of the year. So even though some of those others have taken down their guidance for the full year, it was really more because of the increased shrinkage on, related to the profitability pressure. It wasn't because of sales. that's a bit more concerning here with Dollar Tree, that the sales here are a little bit tougher. And we have a lot of questions for them at the 10 o'clock call that's about to come up. What is going on with the trend, with the consumer? We know the consumer's under pressure, but you would think this is the time for Dollar General to shine and really to capture some market share with that lower income consumer. And it just seems like they're not winning at this moment.
Joe, why do you think that is? Why do you think they're not seeing better results given the macro environment?
So one of the big things we've seen over the past year is Family Dollar, which is part of the Dollar Tree Corporation. Family Dollar has lowered prices quite a bit. They're a lot more competitive with where Dollar General prices are. We've seen, I think, some execution issues at Dollar General as well in terms of the inventory and the flow of the inventory. Also, you've seen other competition like Aldi and Lidl, deep discount grocery, where consumers can go and fulfill some of their grocery needs at pretty much the same or even better prices sometimes than Dollar General. So I think there is some incremental competition out there that is weighing on the results of Dollar General.
For Five Below as well, as we've been kind of looking through their results this morning, all the other retailers seem to be citing some type of back-to-school trend that they're being able to benefit from, at least with the pull forward in some of that demand and expecting it to run all the way through September. Is that not the same case at Five Below?
Yeah, I think it actually is at Five Below. I know their guidance, for the third quarter right now is for same-store sales to be up, flat to 2%, which is kind of in line with what the street was thinking. They actually said back to school's off to a relatively decent start. They called out backpacks, especially clear backpacks, which is a new trend right now among school kids and, being mandated by some school systems. But that trend has actually been okay. So I think they've done all right. And what's interesting, again, in comparison to, say, Dollar General, traffic or transactions at Five Below were up 4.5% in last quarter versus down at Dollar General. And so that's where you see that difference, where I think Five Below, Dollar Tree, some of the others are actually getting the traffic in the stores. I know there's been a little bit more pricing pressure. There's been moderation of inflation, and I think that's starting to come through as well, why the ticket prices are coming down a little. But the traffic's been pretty good. And so we like what we heard out of Five Below.
Joe, what do you think the pricing picture looks like going forward? Because some companies are able to hold prices where they are. They're still seeing that demand for their products. Others, though, if you take a look at Dollar General, they're not able, or they haven't seen that traffic really keep up with what you think it would be up until this point. So are we going to see more promotional activity, do you think, heading into the holiday season?
Yeah, we're hearing from a lot of retailers that we're going to see a bit more normalized promotions, normalized meaning more like pre-pandemic levels. We're hearing a lot of retailers, like Best Buy, Walmart, others have talked about seeing consumers shopping around events like holiday time periods, whether it was, Mother's Day, July 4th, and Halloween is off to a good start, actually. And I think that we're going to see more concentration around the big events in the second half of the year, more similar to those pre-pandemic levels. Now, with that comes discounting. We're not hearing of, crazy discounting because inventory levels are in very good shape for a lot of the retailers, but we are hearing more, quote, normalized promotional levels. Remember, last year was very promotional because inventory was very high and the retailers had to clear it out. So comparatively, it may not look that bad, even though it still will feel somewhat promotional. And as I mentioned, consumers will shop more around those big events.
It sounds like I need to buy my Halloween costume like this week, Joe. I mean, I'm afraid that I won't get the right one that I want. And I think there still is a fair bit of FOMO that is kind of intertwined within some of the numbers for retailers right now. If you've got this much pull forward in demand and making sure that people can get the necessary back to school things and afraid that that's going to fly off shelves, or making sure that I can look like Batman for the second time in 2 consecutive years while I'm getting my Halloween costume. All that pull forward in demand, what does that do for a long-term picture here?
Yeah, I mean, I think what we're seeing is the consumer seems to be somewhat resilient. We're hearing, the consumer is purchasing when they see newness, when they see innovation in the product. And as you mentioned, sometimes just to get ahead of the curve and not miss out on some of the items, especially as inventory has been a little bit leaner this year. I think that we're just seeing we're still on that glide path to whatever the normal levels will be. But we are seeing that big pull forward from the pandemic. We're kind of coming through the worst of that now, through the normalization period. And I think we'll see more regular inventory flows. We're seeing that inventory can get in stock much more quickly and readily as if it was before the pandemic. So with that, it allows customers to shop closer to need or pull forward when they want to, if there's a shortage of inventory. But I think that the normalization is what we're seeing and what we would expect going forward.
Joe Feldman, Telsey Advisory Group Analyst. Thanks for joining us.